Hello, hello. In this video, we are going to analyze Home Depot and Lowe's and figure out which is a better stock to buy today. We're going to look at things that we like about the companies, as well as look at the numbers for quality and valuations. Be sure to like this video and subscribe to help out with the algorithm. Thanks, and now let's jump in. First, let's take a look at things to love about Home Depot. They've got a great history of dividend payouts and growth. Even though they're not a dividend aristocrat, they've been paying a dividend without a cut for over 20 years. And lately, they've been growing it quite a lot. They've got a manageable payout despite those big payout increases, though, with their forward payout ratio. So their payout ratio with what they're expected to make in the next year being under 50%. And lastly, beyond the dividend, they're absolutely fantastic at returning capital to shareholders. So between dividends and buybacks, they've returned $67 billion over the last 5 years and are projected, with dividends and buybacks, to return another $90 billion over the next 5 years. Not only is this a wonderful company, a much beloved home improvement store, but they are really spectacular at returning cash to their shareholders. Next, let's take a look at things to love about Lowe's. They are a dividend king and have been raising their dividend every year for 59 years. That is incredible consistency, and have recently ramped up their raises, or the size of their raises as well, to get their yield up to a competitive rate with Home Depot. Lowe's has an even lower forward payout ratio than Home Depot does, with the forward ratio being about 30%, which just leaves so much more room for growth. They've done it 59 years already, and with a payout ratio of about 30, I wouldn't be surprised to see them do it for the next 59. And lastly, they have improving margins. So they've got a new management team that's been retooling things over the last few years, and they've been focused on really improving productivity, and that should lead to them increasing their profit margins over time. Okay, so next, let's jump into our scoring system, and we'll look at our quality factors. So I've decided to update my scoring system from what I had been using previously, based on wanting to pull in more independent analysis. So I'm going to review the 5 quality factors now and what they are, and then we'll see the grades. First is the value line safety score. So this analyzes a company's total risk compared to other stocks based on things like price stability and financial metrics. Next is value line financial score. So this analyzes a company's finances and balance sheet, things like debt, cash on hand, that sort of stuff. The third is the Simply Safe Dividend score. So we used this in the previous scoring system as well. The Simply Safe Dividend system analyzes the safety of the dividend itself. It uses things like payout ratio, debt, dividend history, things like that. Next, something else we used previously, the Morningstar Moat. So this is either wide, narrow, or non-existent, based on Morningstar's projections of the strength and longevity of a company's competitive advantages. And last, another one that we had previously used is the Chowder-ish score. Because I'm a dividend growth investor, I really like this scoring system. What it does is it adds the company's forward dividend yield to their 5-year average dividend growth rate. And then I also add up to 3 points for buybacks. I cap it at 3 because buybacks don't tend to be consistent year to year, but it is a way of returning a company to return money to me, the shareholder. So I like to factor it in. And this gives me a total score to tell me how good the company is at returning capital to shareholders. The big changes here are adding the value line safety and value line finance measures in. And this is something that I've seen used by different folks that I respect in dividend growth investing, and I think is really a solid way to help analyze the quality of a company. And so without further ado, let's take a look at the score sheet. So first up, we have value line safety. Home Depot scores a 1 and Lowe's scores a 2. 1 being the best score you can get, 2 being the next best score. Both are really good. In my system, that 1 for Home Depot is worth 5 points, and the 2 for Lowe's is worth 4 points. Next is the value line finance. They're both A++. That's the best score you could have. So that is good for 5 points for each company. Next is the Simply Safe Dividend score. Home Depot comes in at 87 and Lowe's at a 93. Both of those are in the highest bracket, being above 81, which gives them both 5 points. Both are very safe. Both have wide moats, which is good for 5 points. It's a very hard industry to break into. If you wanted to make a big box home improvement store, you would need many, many billions of dollars to try to remotely compete with these guys. And lastly, we have the Chowder-ish score. Both of them are over 20%, which is good for 5 points. They're actually very surprisingly close together, almost 25% each. So as far as quality scores go, I mean, these are really, really good. So finding a wonderful company is one step of the process, but no matter how wonderful the company is, you need to make sure that you're buying it at a price that can get you good returns. We're going to take a look at our value metrics, and we try to value the company in a variety of different ways. First up is dividend yield theory. Dividend yield theory states that the dividend of a quality stock will revert to its mean. So here we compare the forward dividend payout with the 5-year dividend average to see how high above that we currently are. That would make it underpriced. We want to see what our headroom is. Next up are Morningstar's. So this is Morningstar's independent analysis of a company's value. It's a 1 to 5 star scale where more is better. We put a particular weight on 4 and 5 star companies. 3 tends to be around fairly priced, 4 and 5 are underpriced, 1 and 2 are overpriced. So that 4 and 5 range is what we're really looking for. Third, we look at the Finbox fair value. So Finbox is investing software that I personally love. They compute a number of different valuations for each company based on which valuation models make the most sense, and then average them together to come up with a fair price estimate. I discount this to 85% of the number they give as a way of getting a margin of safety. And lastly, we look at analysts' fair value. So we take the average of analysts' fair value estimates for the company. Again, I discount it to 85% of that estimate to give us a margin of safety. One thing to note here is we use 5 scores for quality and 4 for value. That's intentional. The reason here is we want to give an edge in total scoring to quality, as we'd rather buy a wonderful company at a fair price than a fair company at a wonderful price. All right, let's look at the value scorecard. Yield theory. Both companies are above 20%, which is good for 5 points, with Home Depot at exactly 20 and Lowe's at 31. Next up are Morningstar's. Home Depot is a 3-star company, right? Lowe's is a 4-star company. You'll note the 3 stars is good for 2 points, while the 4 stars is good for 4 points. This is because at 3 stars, you can be a little overvalued or a little undervalued or exactly fairly valued. And I don't think that's worth the same score as something that's definitively projected as undervalued. So for 5 stars, I give 5. For 4 stars, I give 4. 3 stars, I give 2. 2 stars, I give 1. 1 star gets 0. So that's why there's a little bit of a fall off. Next is the 85% of the Finbox score. That leaves Home Depot with 11.4% upside, good for 3 points. And Lowe's with a 22.5% upside, which is good for 5. And lastly, we'll look at the 85% of analyst fair value. Home Depot has a 16% upside here, good for 4 points. And Lowe's is at 23.5, again, a really big one. And that's good for 5 more points for Lowe's. Great, so now we've done all our scoring. Let's take a look at the overall scores for each of these companies. For Home Depot, we get 39 out of 45 possible points, with a perfect 25 of 25 for quality, and a 14 out of 20 for price, which is good. This is a really high score. For Lowe's, we're coming in even higher, 43 out of 45 points, only losing 1 point for quality and 1 point for price. This is about as good as you'll ever see from a company. It's really, really rare. I keep a huge spreadsheet of different companies scoring, and Lowe's is in a league of its own. So moving on to the final verdict. Both of these companies are currently in my top 10 list, so I have a tracking list where I grade many dividend-paying companies based on these criteria. They're both in my current top 10, and I dollar cost average every week into my top 10 companies. So at the moment, I'm investing into both of them as long as they stay at these prices or keep going down without losing any quality. If I had to pick only one, I would stick to my scores and go with Lowe's, which just seems to be in a really unique position of quality and value right now in the market, and I would be investing heavily there if I had to only pick one, but I think both are truly wonderful. Thanks for sticking around. Let me know in the comments below which of these two you like more and why, and what you think of the new scoring system. Thanks, and we'll see you next time.